Gen Xers, life is good, right? You're enjoying your high incomes and just an overall sense of self and well-being. Yet retirement preparedness is elusive. 38% of Gen Xers will carry a mortgage debt into their retirement. Today, we're going to talk about how to manage your mortgage debt and ways to pay off early. Let's chop. Gen Xers, this is a time to be thriving in life, yet retirement preparedness remains elusive for a lot of you, and there's a lot to be able to manage. Student loan debt, mortgage debt, how you want to retire, your investments, elderly parents, adult children, your own lifestyle, so much on the table. 3 out of 10 Gen Xers will carry mortgage debt into their retirement, and there are ways to manage it and pay it off early. Hi, I'm Dr. Preston Cherry, founder and CEO of Concurrent Wealth Management, where we help you align your life and money so you can live your wealth your way. As always, if you like what you see, hear, and feel on this show, subscribe to the show so you won't miss an episode. All right, let's chop. Mortgage debt, right? Now, we're Gen Xers. If you are in the prime of your life, and you are a homeowner, then you're probably enjoying your primary residence, perhaps wanting to move into another one or downsize. Prices are high as of the recording of this episode, and interest rates are, well, historically, they're about right, 6.5%. You know, we just came out of this low interest rate environment a few years ago, which was an abnormality. That said, how are you going about managing your mortgage debt, and what are your aspirations, right? Retirement preparedness amongst Gen X is at the top of mind, and peace of mind is at top of mind as well. One of the things I hear from clients at Concurrent Wealth is that two things actually is to contribute more money to retirement to solidify it and get more confidence in that area, and reduce any outflows now and during retirement, so you can have more confidence in the lifestyle that you want to live. Mortgage debt is one of the number one or top amounts that we have to pay out as far as cash flows are concerned. So how do you go about addressing that? Well, first, let's go to how mortgage debt affects Gen X in particularly, right? 1 in 4 homeowners age 65 and older are going to carry debt into retirement, are currently doing so right now, right? And what comes with a paid off house, right, is significant peace of mind. Also, too, the quicker that you can, pay down your mortgage, you accelerate your retirement date, right? Even though some people are taking in the mortgage debt into retirement, it's really about peace of mind. You can go about addressing your mortgage and retirement at the same time. It's an and, not a or, right? So what I hear often is that, people are staying in the place that they are longer and not wanting to upscale their current home. Right now, most Gen Xers have either older teenagers or, young adults in their home, and they may even be empty nesters. I have a lot of clients that are empty nesters. And with that, particularly with home prices continually to climb, then, going into a second or another home by upscaling is really not on the table, because there's so much other ways of or parts of life that people want to live, right? So over investing into a home, right, could be a barrier to lifestyle and retirement preparedness, particularly for Gen X with all of what you have on the table. Another thing about Gen X comparative to other generations, there's lower equity in homes, although they're further along in home ownership. And that could be from refinancing because of, the way life's course has taken you, or perhaps funding lifestyle, whatever it may be. Equity is lower amongst Gen X, thus the higher debt too. But the proximity to retirement is closer. So there's This is a topic that must be addressed, and even amongst higher income folks as well. When you have higher income, then you also have a little bit of lifestyle creep as well. So even though that's not all bad, that said, when you have a high cash flow outlay like a mortgage, you want to button that up a little bit. So with all that, how do you go about addressing your mortgage payment? Most folks want to pay off their homes before they enter retirement and even early. So how do you go about doing that? There's about four or five strategies that you could do. So let's get into it. So the first way would be to have biweekly payments rather than monthly payments. And this is a way to reduce your interest over the life of your loan. And with reduced interest, if you're not paying interest, then you are putting that money back into your pocket and using that cash flow for either lifestyle or investment purposes for retirement. So this is a good way that doesn't put a strain on cash flows or budgets. It just increases the frequency of your payment and still reduces the interest over time. Another advantage of biweekly payments is it's kind of a set it and forget it, right? So you could automate biweekly payments all day long. Another way of paying off your mortgage early is applying one additional payment per year to your mortgage. This is a significant way to trim off 4 to 5 years of term on your loan term. So if you have a 30-year term, then you could apply one payment per year and trim off 4 to 5 years and turn that 30-year loan into a 5 year. Again, this is another way of saving interest in your pocket and transferring the interest that you would otherwise be paying to the bank into your pocket and allocating toward the goals that you want. And the way you would do this is take a lump sum of money and apply it to principal. And with reduced principal, then you have reduced interest payments as well. So this provides you with a little flexibility because you can have a little piggy bank that you're funding over the year, or you have money from a windfall, such as a bonus or something to this effect, and then you can apply that to an additional payment per month. Speaking of windfalls, another way to use your bonuses is to apply that large windfall bonus, gift, perhaps inheritance, a windfall, right? You got some money that's unexpected that comes into your pocket. Perhaps you have some, RSUs, restricted stock units, a little bit of bonus money that comes in, and you can apply this lump sum not only to one goal, but perhaps multiple goals. And one of them would be, how about we pay off some of the mortgage that we have? So using your windfalls for either a one-time extra payment per year or even just a lump sum payment towards principal at a random a time when you receive a windfall. Now, moving on to another way to pay off your mortgage early is simply this is a popular one, refinance. You can refinance your mortgage payment. The most popular term is 30 years, right? And with a 30-year term, then your monthly payment is lower than what you would have from a 15-year term. Now, the thing about a 30-year term is you're paying more interest over time and you have a mortgage note longer, right? 30 years versus 15. So if you can afford a little bump up in your mortgage payment per month, right? Then you can reduce the term from 30 to 15 and pay a higher amount per month, but you get a quicker payoff though, right? And that's the goal. And if you are motivated by wanting to be done early and you don't have to put a lump sum towards your mortgage, then you can refinance and break that additional, payments up, like that acceleration of paying your loan up, right, in monthly chunks because your monthly payment is going to be higher. So that's another way to set it and forget it, and knowing that once you refinance, you're going to have the same payment, although higher per month, but you have a shorter period of time and you're saving money once again of interest and time and peace of mind, right? In order to transfer that otherwise interest payment to other areas like funding retirement. Also, what's good about refinancing is if you can refinance from a higher rate to a lower rate. Now, the way the rates are currently, you may have a rate that's lower than 6.5, so refinancing may not be ideal. So when rates are high and you have a lower rate, then you may just want to keep that and apply one of the other payment methods, such as one-time payment, additional payment, or biweekly payments. All right, and coming around the bend is a mortgage recast. Well, this is not well talked about as a mortgage recast. And a mortgage recast says, well, if you have some additional cash that's at your disposal, whether through a bonus, a windfall, or you have heavy cash in your investment accounts, it's like, okay, I want to put that to good use, right? Or you can take a lump sum, place it towards your mortgage payment, and then ask the bank to recast your loan based on you taking that money and paying down the principal in that lump sum amount, right? And what happens here is that when you pay off or pay down principal a little lower, and then now you can recalculate. It's like using a mortgage calculator, recalculate your mortgage using a lower principal payment. And what that's going to do is not necessarily change your interest rates, not going to do that. However, it will lower your monthly payment per month. And that way you have additional cash flows to either use for your lifestyle preferences, gives you some lifestyle flexibility there, or use that money to, again, fund retirement preparedness. And this is what we're looking for overall across all of these strategies is a few things, which is transferring the monies that you would otherwise have to pay towards interest over time, right, to the areas that you value most, whether it be lifestyle or retirement preparedness. And retirement preparedness is key because we're trying to find more cash flows in order to fund retirement over time, right? And if we're not paying interest over to the bank, it's just another way to redirect that monies into the lifestyle and areas that we value most. So now let's take a quick recap of what the benefits are of these 5 strategies. And the main one is to save interest over time. And whether you are automating your payments as far as one-time payment, additional payment per year, bi-weekly, or you are refinancing or recasting, all right, these areas are putting a lump sum, paying less interest over time is key because now you found a swath of money that you can now transfer to the goals that you value most, particularly retirement preparedness. And the most important when you're paying off early is just peace of mind. Peace of mind when you're in retirement, not having to worry about your rents going up or any of that nature. And you have a home that's a roof over your head and everything else is steady as you go. So peace of mind, right? All right, our last one is to avoid some common mistakes when you're going about paying off your mortgage early. What do people do? I've heard a lot. Here's a couple. The most popular mistake that I've heard is folks using their retirement account monies and say your 401ks or IRAs or even your emergency funds to use one of these strategies to pay off your mortgage quicker. Those monies are for what they're for, right? Retirement and emergencies, right? So you don't want to be pulling money from earmarked funds for those, and then you increase under preparedness for retirement and also increase your exposure to emergencies by having a lower emergency fund. So you want to use those funds and have them at the ready for what they're intended for. Because you already have a mortgage payment. You can just continue to make it. You don't have to pull monies out of other areas like retirement and emergency fund in order to do so. Okay, next to number 1, here's number 2, which is opportunity cost, right? So if you have a lower interest rate, then placing lump sums of money on a principal payment to the mortgage may be a lost opportunity cost because you have a low interest rate, say 3-4%, and you're not earning the historical 8, 9, 10, 11, 12, perhaps percent in the market, right? So that's a big difference. You can go about using a biweekly payment or an additional payment per month, and then using more of your cash flow to place towards investments. And then once your investments grow, right, to your desired retirement amount and you're on track, then perhaps you can use some of your flexibility funds in your brokerage account and then use some of those extra funds to pay down your mortgage. But you don't want to have too much lost opportunity cost by applying monies toward a low interest mortgage and sacrificing higher returns in the market. Secondly, you could do both, right? And then there's a big one, number 3, which is early payoff fees. So you want to be mindful of early payoff mortgage fees from your bank when you are exploring, say, a refinance cost is another thing. So early mortgage payoff is a big one, and then also refinance fees. So you want to be able to look at and calculate what those fees are and what are the advantages and disadvantages of incurring those fees, and so you can pay off your mortgage. All right. Well, mortgage payoff. This is mortgages are one of the highest outflows of your lifestyle now and during retirement. The next are medical and a lot more. These are the highest too. So when you go into retirement, right, you're already trying to fund the risk of outliving your income, having to fund your lifestyles, your aspirations. Hey, you worked hard. You want to have a good lifestyle, right? And then also higher medical costs over time. So having an additional debt payment during that time is not ideal and threatens those other areas. But, being able to have good health and pay for it, a great lifestyle, and have your money last longer to your desired amount, right? All right, that's the show that we got for you. If you like what you've seen, heard, and feel on the show, then like and subscribe, share with your friends, colleagues, and family. All right, and until next time, we'll chat soon. Cheers.